All right, welcome back to the third edition of the Kansas City Commercial Real Estate Market Pulse, sponsored by Exchange Commercial Real Estate. I'm joined today by Micah Beebe, one of our brokers on the multifamily side, and Nick Morales, our Director of Capital Markets, Investments, and also a broker here at Exchange. How you guys doing today?
Doing well, Logan.
Doing great, man. It's another great day in real estate.
Well, I love to hear that, guys. We have a lot of fun things to cover today, and I am working on trying to figure out a little bit of technical difficulty on my side. And that's why we're a couple minutes late here, but every time I want to change a slide here, it's making me go to a different tab. So I apologize for that. So just give me a few seconds to get that figured out. But Nick, Micah, can you confirm that you guys are still seeing my screen here that's shared?
I am.
Yep.
All right.
You're good, man.
Wonderful. So as you guys know, this is the third time that we have done the Kansas City Commercial Real Estate Market Pulse. And I mean, what we're trying to accomplish here is pretty simple. But I took a landscape. We all took a kind of a market snapshot of the landscape in Kansas City and figured out there was no real valuable, up-to-date information on the Kansas City commercial real estate market on a regular basis. So that's including current listings, market trends, any transaction overviews that we would want to be talking about on a regular basis. And so we decided to create that infrastructure and create that database and create that weekly, bi-weekly stream of information to investors, to brokers in the industry, to property owners, and to buyers. And so we are getting a lot of great feedback about this, and it will, I'm sure, iterate over time. But for now, what we're doing is going through some notable transactions, and then we're trying to take kind of the most pressing conversations that we're having with property owners and bringing those to the market. For example, we talked a lot about return on equity last week being one of the most underutilized and probably misunderstood return on investment metrics in the commercial real estate industry, and how that, if you understand what your return on equity is in your project, then how you can unlock a lot of growth through 1031 exchanges using ROE. And what it tells you is really, should I hold, should I do a sale or look at doing a sale, or should I refinance this project? And I think that is a really cool component to what we're doing here on a regular basis, is bringing that education that we are seeing on a regular basis and talking with our clients and a lot of prospects on, and bringing that to the masses. And I hope that this will transition into other modes. We're live here on LinkedIn, and we are live on YouTube right now. And our goal is to get this to podcast platforms at some point in the near future. But for example, that information on ROE was so good last week that we have snipped that down into a 20-minute video and have all of those slides ready for consumption for all of our prospects. And we'll be sending those out here shortly. So very exciting stuff, what we're doing here with the Kansas City Market Pulse. But if you ever have any interest in specific topics, or you want us to focus in one area, please reach out to myself, to Katie, to anyone here on this great team, Micah, Nick, Chad, Nathan, Max, myself. We'd love to speak with you and either feature you on the Kansas City Market Pulse or have your answers or your questions answered here live. So without further ado, you guys know who our team is. Let's jump into some of the meat and potatoes. Nick, Micah, some really interesting transactions that have happened recently here in Kansas City. I would say the number one that everyone is talking about in Kansas City is the Country Club Plaza, which sold to HP Village Management. If you've been down to Texas, and I'm going to let Micah talk about this because he's our Texas guy here on the show today. But if you've been down to Texas, there's a very specific area of Texas that I would like to highlight here in a second. But this is the point that I want to make before I hand the baton over to Micah to talk a little bit more about HP Village, and Nick and I can banter about getting a smoking done at Graham and Dunn on the plaza. Still one of my favorite drinks in the city. But look at this. This thing sold for $660 million in March of 2016. We're talking about a price that HP paid about $175. That is a notable reduction in price. So what does that allow HP to actually do? Well, what it allows them to do is have a decent basis. And Mike, I don't know how many square foot the plaza is and what this is on a per square foot basis, but what it allows HP to really do is focus on some of these major CapEx things that need to happen on the plaza. And I do believe they have either 100 million or close to 100 million scheduled for CapEx just to go back into this project. And KD might have to keep my figures correct there, but I'm pretty sure that's what the number was very close to that. And that's road infrastructure, that is security, that is upkeep of the buildings, which is very exciting. But Micah, talk to us about HP and what they've done down in Texas, and any thoughts that you have around the plaza.
Yeah, well, I mean, the plaza has always been a really fantastic area in Kansas City. Everybody loves the plaza. It's such a walkable, friendly place to go to. It's beautiful down there, and it's one of the jewels in the crown in Kansas City. And you've got all the beautiful fountains, and then there's all the lights that go on around the holidays and Christmas. And it's just a great place that everybody loves to go to. Unfortunately, we've seen some vacancies. There's some projects that kind of fell through, on the west side of the plaza. I think the owners they're in the process of figuring all of that out and what's going to go in that space. But I was really excited to see this ownership group come up because I know that they have ownership in a property down in Highland Park. Sorry.
Highland Park. Yes.
Yes. Those are two different locations in the Dallas-Fort Worth area, which I lived in for over a decade. And Highland Park is an incredible part of town. Very, very nice part of town. A lot of high-end retail, and just an incredible part of town. And if you've ever been there, you know that. If you haven't been and you're in the Dallas area, it's definitely a really cool part of town to go check out. And you'll see what I'm talking about. But to have this ownership group come in with that already in their portfolio and that kind of experience, these guys know what they're doing. They definitely know what they're doing. And to have them come in and take a project like the Country Club Plaza, I am very, very excited to see what these guys do. Because when it comes to high-end retail and implementing a luxury product and having a high-end piece of real estate, these guys know how to do that.
Yeah.
And so, and you're totally right on your figure. I mean, reports that I was seeing were saying around $100 million of renovations. I did see one report that said 200 million. I don't know if that's accurate. I don't know if they're updating their figures and changing that. I could be wrong on that, but I did see just one report out there that said 200 million. So I don't know if they're increasing that or if it's still just 100 million. We need to verify that. But
yeah.
But it'll be really exciting to see what these guys do with it. And
yes.
It's an exciting time for the plaza and for Kansas City to see that type of investment in such a well-known and beloved part of town.
Absolutely. It's modeled after Seville, Spain. It's a very cool area. And I saw yesterday that one of the Kansas City groups here had a forum around all the excitement going on in Kansas City. And so, Nick, what are you most excited about with the Country Club Plaza? And excited about some of the upgrades that they might be doing and what that might do to commercial real estate here.
Well, the from a selfish perspective, it was a huge draw here in Kansas City was the plaza. I mean, that's, you talk to Kansas City, you're like, the one thing you have to do to check off your list is get to the plaza, because it's been a bright spot for Kansas City, and because it's been beautiful and the attraction of restaurants and shops and everything. And that has obviously deteriorated over the last couple of years. So getting that back to be a stronghold within the Kansas City footprint, I think will serve well, not only for the city, but surrounding businesses and everything else, to get a boost back to surrounding areas, Waldo to, Westport, that whole area.
Yeah.
I think the impact is huge, and the ripple effect will be vast. So
absolutely. And I just did some research. The plaza consists of around 18 separate buildings representing close to 785,000 square feet. So 175,785,000 square feet puts that about $223 a square foot in regards to the retail per square foot basis there on the plaza. And one thing I'm excited about is it usually, it was a place where you could go get that local feel. It was the Kansas City Starlight. A lot of people wanted to come there just to go to the plaza. But it had this local feel, and a lot of those local tenants unfortunately started to leave the plaza for a multitude of reasons. And I think that HP is bought into getting that local feel back. And I've seen some reports of them already talking with some groups that were there previously. So very excited about that. But interesting to note here, guys, is that the Raphael Hotel, which is where I spent my wedding night, believe it or not, at the Raphael, were both purchased by Texas-based investor groups, right? They're unrelated, but it's very interesting that they're both from a similar area of the suburbs of Dallas. So Bentley Legacy Holdings primarily owns and manages hospitality properties. They have some restaurants and offices in their portfolio as well. And Kansas City is their first, the Raphael Hotel is their first Kansas City property. So that was really interesting to note that, the plaza and the Raphael Hotel, which is on the plaza, is both being bought by, or have been bought by, Texas-based investment groups. So really interesting to see money coming from Texas up here to the Midwest. We had a couple other notable transactions here just recently. Blackburn multifamily for about $39 million. The reserve on 31st was $20.75 million. And then if you've ever been to Topeka, Kansas, Wanamaker Drive there is the main thoroughfare through Topeka, and a large retail center was purchased there for $14.7 million. So transactions still happening. We're going to talk a little bit more about the market and the waterfall effect here in a few slides, but exciting stuff here going on in Kansas City. Lots of buzz in regards to the plaza. So what has happened? Yeah, go ahead, Micah.
Sorry to interrupt you there, Logan, but I mean, one other keynote to plug in here too is the fact that the city is implementing the streetcar extension all the way down to the plaza, and that's certainly going to have an impact, especially when we're a host city for the World Cup here in about 2 years, which I know they're trying to get that done before the World Cup comes in. So we're going to see a tremendous amount of people and patrons coming in and out of there. And so I think we're going to see a lot of fantastic activity around the plaza and downtown, and that streetcar is going to be an integral part in connecting the city. So that'll be another exciting piece of all of this, how the streetcar connects everything in that area.
Absolutely. It's a great point to make, Micah, because as Kansas City continues to focus on infrastructure upgrades and large projects like the plaza, how those events go are going to be very indicative of those events being attracted to Kansas City in the future, right? And that's going to be really important for tourism, for hospitality, for people to talk about real estate just in general around Kansas City, and putting it more on the map in regards to people wanting to move to Kansas City, businesses being involved, having locations in Kansas City. We're seeing it happen in the suburbs quite a bit, but very excited about the infrastructure projects with the new airport, with the streetcar construction, hopefully getting done by 2026. And that just the ability for people to be able to get around and for us to be able to actually effectively host these events is going to be a real driver for a lot of different economic activity in Kansas City. Let's move on to multifamily sales. Where are Kansas City apartment sales at? Okay, so multifamily sales activity in Kansas City slowed. Not surprising. This is a nationwide trend, but absolutely slowed in the first half of 2024. Through the first 2 quarters of the year, just over 2,200 apartment units were sold. This is the lowest level since 2010. I'm going to say that again. The lowest level since 2010, when the market was recovering from the great financial crisis. And it was 44% at that time below the yearly average since 2008. So why is that happening? Not just in Kansas City, but nationwide. Well, a combination of higher borrowing costs driven by the Federal Reserve raising its benchmark rate by 550 basis points from March of 2022 to January of 2024. And slowing rent growth has led to a shift in the way that assets are being underwritten. So we were averaging 5.4% annually in each of the past 2 years. Rent growth has slowed to just 3.2% at the end of the second quarter. While that still puts Kansas City in the top 10 markets across the country with at least 75,000 units of inventory, it's significantly above the national average of 1.1%, but that is a 40% drop from recent trends, right? So that's impacting the transaction activity from a new buyer standpoint, because if they're not able to underwrite 5-6% rent growth effectively and have that be on their pro formas and their business plans, they're not going to be able to pay as much for those assets. Pair that with higher interest and borrowing costs, that's created quite the slowdown. Now, that being said, when we look at the current market, we got private high net worth individuals, family offices are likely buyers, right? Institutional players and REITs have scaled back their acquisitions over the past 18 months and have not made a comeback yet. What does that mean for the market? Well, that is a lot of dry powder that is sitting, waiting, and ready to be deployed. So since the start of 2023, institutions and REITs have been involved in 5% of market purchases compared to 18% from 2017 to 2022. So when we talk about the waterfall effect happening here in the next couple slides, that is a very important note to make. They're only in 5% of the transactions right now. That's down from 18% from 2017 to 2022. So with less institutional capital being deployed, sales at the 4- and 5-star properties have declined the most. So through the first half of the year, 3 sales totaling around 851 units have occurred amongst that category of properties. From 2020 to 2022, that averaged nearly 2,100 units. So, I mean, that is a massive shift. And that's led to more sales in the 1- and 2-star market segments, which tend to be smaller assets of less than 50 units. Of the last 42 sales in the year's first half, 70% of those sales were in this category below 50 units. So that is a very big trend to keep your guys' eye on, and one that we are playing in quite a bit, right? I mean, that's kind of our market segment, is right around 50 to 100 units. And that's really where a lot of these transactions have happening. Now, multifamily sales. Typically, the second half of the year is typically more active. And so this slow start paired alongside the high borrowing cost is been keeping sales subdued. But we are having a lot of conversations with property owners and with investors, and that renewed sentiment and that positivity seems to be moving throughout the market. Pair that alongside with what we're going to say is the waterfall effect of this forward-looking interest rate drop, and I think that the end of Q3, Q4, and Q1 of next year could be really strong. Micah, what did you take away from looking at this figure, which is pretty stark, right? I mean, being declined, a 50% decline is a pretty stark number. But when you actually look at that data, we're starting to see, and this is typical of the commercial real estate market, is those transactions happening in the smaller side and then moving up and waiting for the REITs and the institutions to kind of really deploy their capital, knowing that there's a lot of dry powder on the sidelines. What do you see happening in the future?
Yeah, it's really interesting to see the decline. And like you said, I mean, Kansas City, I think, is still a bright spot within multifamily. I mean, yeah, in our peak, we saw sales hit a little over $2 billion in Kansas City, just in the multifamily space. And so we've come down significantly from that high point. And so I think that the investor sentiment right now is that everybody's still kind of cautious. I think there's still a bit of that gap that we talked a lot about over the last year or two, where you had that standoff position between buyers and sellers, and the sellers still trying to accept where the market is, and then buyers saying, I'm not going to pay the same prices that I did in 2021,
Right.
And so, but I believe that we have been seeing that gap begin to close in, which has been positive, which is why we're still seeing things transact. And I think that there is a bit of optimism because everybody can kind of feel and hope that an interest rate cut is coming. We're seeing more indications that is going to be the case. Of course, there's no crystal ball out there. There's no guarantees. We're just saying, hey, we're hopeful here. We think it's coming. And so, I mean, what I've heard is that the latter part of this year is going to see more transactions coming. And we're kind of waiting for that wave. And the question I think out there is, how big is that wave going to be? I think that's going to be a really big question is, okay, so we've got a wave. We've got some maybe pent up demand there. We've got investors that are ready to deploy some of that dry powder that's been sitting on the sidelines, because some investors kind of anticipating where the economy was headed were putting money and kind of allocating that for distressed properties. And yes, we're seeing distress, not at the scale that some had anticipated, but I think investors are kind of waiting for, when can we jump in here and start to buy some of these assets up. But sellers have been a little bit slow to bring things to market. I mean, the market is kind of light with opportunities. Again, opportunities are still there, but yeah, they're light right now. But again, I do want to strike on that tone of optimism for the future and what we're going to see for the latter half of this year.
Yeah, those are great points to be made here. And, one of the points that we've been making with owners right now is that, look, we get an objection quite a bit, or some resistance saying, well, I'm going to wait until interest rates come down until I sell my property because I'm going to get more for it. I say, well, what are you planning to do with the proceeds from the sale? Well, I'm going to do a 1031 exchange. Okay. Well, if you're going to wait to sell when it's more competitive because interest rates have come down, then you're probably going to have to pay a higher price for your replacement property. And so now you're wiping out basically the gains that you would have had if you're selling now for an acceptable price, being able to buy at a lower price per door instead of waiting until interest rates drop to get a higher price for your property and having to pay a higher price for a replacement property. Right. And so I think that's something to be really cognizant of, is if you're an owner right now, understanding what the return on equity is in your current project and knowing that it might be a good time to sell your asset, as we are getting right before that period of time of increased likelihood of increased activity and more buyers coming into the market. Yes, you may get a little bit more for your property, but will you be able to find your replacement property? I don't know. That's the hard part to compete with. And so we've been posing that question to property owners and having a lot of good advising type of conversations around that. And I think that's a really important part to remember, right? Is like you have to take the long-term view here. And look, like Green Street Property Price Index just came out yesterday and said that prices already this year have gone up 1.7%. And that's likely a trend that's going to continue. And so if you're looking from an acquisition standpoint, now might be a really good time to get into the market. Anything that I missed, guys, or any points that you wanted to make before we move on to understanding what the waterfall effect is here in commercial real estate?
Not for me.
No, I think it's kind of hard to jump in there and really time out the market, and I've got to line everything up and just be so perfectly in tune with everything. And it's a difficult game to play when you're trying to do that.
Yeah. Well, the waterfall effect is something that we track on a regular basis, and we're really trying to help bring forward-looking thoughts to commercial real estate property owners, because all of the reports that we get in the commercial real estate industry are looking through the rearview mirror. We need to be looking through the windshield, right? And so this is the moment that commercial real estate industry has been waiting for quite some time. And so we are talking and advising owners to brace yourself for this waterfall effect. And the question that I've been posing on LinkedIn is the commercial real estate market about to see a massive shift, right? And so I found Cushman & Wakefield CEO, Michelle McKay, she thinks so. And she's calling it the waterfall effect. So here's the breakdown, right? You have a reduction in interest rates. So when the Fed cuts rates, borrowing becomes cheaper. This reduction can stimulate investment in commercial properties. And then we're going to have an increased investment in transactions. So lower borrowing costs lead to more real estate transactions. Investors are more likely to buy and develop properties when financing is affordable. And this surge boosts leasing and capital market revenues. And then it starts to really impact what Howard Marks talks about, which is the sentiment, right? Is when that market pendulum starts to swing. And that's the enhanced market optimism. So anticipation of rate cuts can boost market sentiment, right? And investors and companies get more optimistic, leading to aggressive and investment strategies and larger deals. And that can increase property values. So increased demand due to cheaper financing can drive up property values. And this appreciation obviously benefits existing property owners and spurs further investments like we just talked about. This is the big component that a lot of folks have been waiting on. And this is that stabilization of capital markets. Not only the lower cost of capital improves the market liquidity and stability, but knowing that interest rates aren't going to continue to rise at the rapid rate that they have creates stability. And all of this is the waterfall effect triggered by this interest rate cut. And this could lead to a cascade of increased investment, higher transaction volumes, and improved market sentiment. We might have rising property values and more stable capital markets. What do you guys think about this? Are we on the brink of a commercial real estate boom or just more empty promises? Give me your thoughts, Nick.
It's, it depends on who has your ear on what day, as I say candidly every day, who you're going to believe in and who you're going to buy into. So it'll be interesting to see, if the Feds do in fact cut rates, because that's obviously going to be the first as far as a trigger effect to all this happening. So it'll be interesting to see. But like I said, it depends on who has your ear what day and what narrative they're trying to control out of that. But for all intents and purposes, and without going down the rabbit hole of Ray Dalio, it all seems to be in line with the 17, 18-year effect. And I think the timing is there. It's just going to take one trigger event to start the landslide, so to speak. So,
yeah, absolutely. And I think that in a couple of weeks, we will have to do a deep dive into the 18.6-year real estate cycle. This is a fascinating phenomenon that Phil Anderson has written extensively about in his book, The Secret Life of Banking and Real Estate. But it's based off of Fred Harrison's book that he wrote in the 1980s. And it's a really interesting read. It's really just phenomenal in regards to the historical perspective of land prices in commercial real estate in the United States. So we will likely do a deep dive on that upcoming. But I was tracking the waterfall effect last week, and I thought that the first trickle started downhill last week because the Fed held the steady on the rates, but they hinted at that September cut, right? So Jerome Powell announced that while the FOMC maintained the current interest rate of 5.25 to 5.5, a potential rate cut could come as early as September. And what happened on, Micah, you probably tracked this, but what happened on Monday in the stock market in regards to all of this market activity? And, everybody checks what Warren Buffett does on a regular basis, but Monday was a big day for Wall Street. And I think that first trickle started downhill. Talk to me about what you're seeing in the market.
Yeah, Monday was an interesting day. I mean, we saw one big drop. I mean, we saw the 10-year Treasury go below 4% and got all the way down to 3.7.
Yeah,
I think it was at one point, and which, I mean, it didn't even get that low. I mean, it had dipped back in December, but it did not dip that low back in December. I think, talking to some property owners back in November, we were seeing rates or the 10-year Treasury kind of trend a little bit downward and get down below that 4% mark. And we're like, okay, this is great. We're feeling good. That's when we were really expecting that rate cut to come early in the year, which did not happen. But then Monday rolls around and we see that drop happen. It was quite interesting. But I was actually listening to a podcast at the end of last week, and it was interesting because they had talked about where the market was headed, and they said, the stock market is there's a dip that's incoming. Which I thought was interesting. So they kind of predicted that this was on its way, but they said, listen, it's important. Don't freak out. Okay. This is going to happen. You don't need to liquidate and cash everything out right now. It's a dip in the market. We're going to see this as a blip on the radar. So the important thing is don't panic. I'm sure Ray Dalio would advise that as well. Don't panic. But no, it was Monday was definitely an interesting day, and we're starting to see. The 10-year Treasury has come back up since then, but it's still hovering below that 4% mark.
Yeah. The 10-year yield hit a 4-month low. I think that provided some comfort for some investors. In regards to the stock market, yes, there was $31 billion that got drained from the stock market. But look, that's a game that people play. And that's a game that when they think, hey, I've had enough gains, I'm taking some chips off the table, that's what they're going to do. Right. And yes, there were some reports that came out with the jobs report and a few other things that might have scared some people. But at the end of the day, we dropped back to our level that we were at in the stock market in April of this year. Okay. So, there's a lot to be said about where we were from a extremely high level, just dropping back to a relatively high level in the stock market. So it'll be interesting to watch what happens in the future. The other impact that I'm watching as the waterfall effect continues is cap rates and bond yields. I've been watching cap rates closely now for about 8 years. And when I started to witness what I thought was a recent peak, I knew it was a signal. And so I went out and found some self-fulfilling prophecies, right? I went and found a CBRE study that said 3,600 other market participants agreed with me. And this is a signal of a shifting market with a recovery on the horizon. It reminded me of studying 2010 when similar trends emerged. So here's how we're advising for the upcoming changes. Back in 2010, cap rates expanded before a major recovery. This trend signaled undervalued properties at the time, and it was a chance to invest wisely. Today, that pattern could be repeating. Look, history has a way of repeating itself. Like Mark Twain always says, it doesn't repeat, but it sure does rhyme. And you have to understand past recoveries, which that can definitely help your future decisions. It provides a roadmap for current strategies, and we're using these insights now to help drive our clients' decisions. So here's kind of how we're advising clients right now is we're seeking properties with stable income. We're diversifying across different asset types and focusing on areas with growth potential. It's all about smart adjustments. By learning from the past, we can navigate future shifts. And projections are pointing to a recovery by 2025. I think there's a clear path right now for strategic planning. And so I think it's really important to talk with someone, to talk with a team like our team here at Exchange Commercial Real Estate that is tracking all of these cap rates, these bond yields, the historic perspective, what's going on with notable transactions in the market right now, and being able to understand, should I hold? Do I need to refinance? Or should I look for a sale, right? I think it's a good process to do a quarterly analysis of your investment. So please, if you're interested in thinking about understanding your return on equity, what's available out there in the marketplace, reach out to one of our advisors, and we'll be happy to walk you through kind of our thought process in regards to where we're at right now in the market and what's to come here in the future. Everybody's favorite topic right now seemingly is the election. So we will not get political by any means. That is not our job. But our friends over at MMG did a great job putting together a research piece on how to navigate the election bump and creating some insights for real estate investors. So obviously we know we got a presidential election progressing right now, and historical perspective of this would kind of per se that there is an election bump, and an election bump just being traditionally being times of increased market volatility. That's where this phrase election bump comes from. It refers to the temporary uptick, which can impact various economic indicators, right? And not only do we have an election going on, we have everything that we just talked about in regards to the Federal Reserve and that potential waterfall effect happening. But this election bump can signify a noticeable rise in economic activity during election periods. And historically, this surge appears in areas like the stock market. Well, what did we just see? Consumer confidence. For example, businesses might ramp up investment in anticipation of favorable policy shifts, while consumer confidence can grow due to expectations of lower taxes. So how does that, what factors are actually indicated, what economic indicators are influenced by elections? Well, the stock market trends we've already kind of talked about. We've been at a high in the stock market. All-time highs continue to happen in the stock market, right? Yes, there was a big sell-off on Monday, but I think that all indication is it's going to continue to rise for the short term. But election periods do often bring heightened volatility to the stock market. And that's exactly what we're seeing right now. You have business investments. I mean, businesses can either be cautious or they can be aggressive during economic times during elections, because they're waiting to see what policies may or may not be impacting their business, right? The job market is another one, right? And that's really important, because if they don't feel like they're going to be able to staff appropriately for future growth, that's going to have them pulling back, right? All the indicators in regards to not just jobs, but manufacturing, CapEx spending are still at very, very healthy levels. And that all kind of then transitions into consumer confidence, right? And that sentiment is typically experienced as a boost during election years due to heightened political engagement and the anticipation of those policy changes. But what I thought was really interesting is looking at, and MMG did a great job of actually looking at these policy changes and what their policy changes are for the impact of this, right? I mean, this is the biggest one probably being tax reforms and government spending. Like, these are two big areas that most businesses and investors are going to be watching, because that significantly impacts the economy. And we have regulatory changes as well, right? I mean, elections often lead to shifts in regulatory landscapes. Could be in regards to trade and offshoring or onshoring supply chains. That was a huge trend that we saw during COVID-19, was businesses wanted to get their supply chains back onshore here in Kansas City and in other markets. But that's what drove a lot of the industrial, flex industrial boom in the United States of the past couple of years, right? Now, I think that, people say, hey, well, if a Republican wins, this is going to happen. If a Democrat wins, this is going to happen, right? Well, let's take a look. I mean, immediately following Trump's 2016 victory, right, the stock market went up. Businesses were excited because of the pro-business stance. Well, what happened when Joe Biden won? Well, the stock market went up. Business trends were a little bit more mixed. But, for example, renewable energy anticipated favorable policies, right? And the ESG market boomed when Biden won. So I think that looking from a historical perspective, there's really no, from a commercial real estate standpoint, there's really no correlation that we can directly make if a Republican wins or Democrat wins. We talk a lot about the 1031 exchange and whether that is going to impact if a Democrat or a Republican gets in, if that's going to go away. That has happened every election cycle. Okay. That has been in place for a long time. There has been some great reports done and studies done on the impact of GDP from 1031 exchanges, not just from the transaction volumes, but when a new property gets purchased. Transaction volumes drive fee revenue, which also drives construction activity, and readaptive use projects bring more businesses to mixed use buildings, right? And so I've talked to a lot of 1031 exchange experts and qualified intermediaries, and frankly, with the National Association of Realtors and the lobbyists in Washington in regards to the 1031 exchange, I don't think it has any real chance of being taken away anytime soon. It's been in place for a long time. I think that's going to continue. So historical perspective, winners on the Republican, in the Democrat side. I think that in commercial real estate, we're going to be just fine. Most people are watching the Federal Reserve and what that is going to happen. So that's a big impact, obviously, because a lot of people want to talk about, well, I'm going to wait until after the election. Well, Micah, why would someone wait until after the election? I found during the last election year what was really interesting. Yes, transaction volume did go down, but we transacted, and we transacted a lot because other people were not doing that during that period of time, which was a really interesting kind of opportunity or window for people who are willing to step in at that time. But what do you think the pushback is during elections for property owners?
Well, I think they're waiting to see which candidate is going to win. And obviously they're focused in on a particular candidate and hoping that the one that they're choosing to vote for is going to get elected. And they're hopeful that those policies that they like are going to be implemented. And so I think there's, people kind of step off the gas a little bit during an election year. And we do see things take a little bit of a dip historically because they're just kind of in that wait and see mode of, okay, which direction is this going to go? And is this going to benefit me or what? And, and so that's really where owners find themselves. And, during the last election cycle, I was talking to a particular buyer that was looking at a property, and and he's kind of making all kinds of predictions of when this happens and that happens. And I feel like everybody kind of wants to pull out their crystal ball as to what they think is going to take place depending on who wins. And it's like you don't really know which direction it's going to go in with who's going to win. A lot of people think one candidate's going to win over the other, but you don't really know until election day. I mean, go back to the last two election cycles, between Biden and Trump, and a lot of people thought that Trump was going to win and went in another direction. And then just likewise in 2016, a lot of people thought that Clinton was going to win, and it went to Trump. And so, it's again, you can't really predict the future as to how these things are going to land. But but no, I think you've got to take a pragmatic look about what's happening currently, and plus with the new administration coming in, whichever one that is, it's going to take time for any kind of policies to be implemented.
Yes.
So,
Yes.
I mean, I think that's the other thing to keep in mind. That we're probably going to be in the state that we're in for a little while, and I think there's some runway there, and depending on which candidate gets in the Oval Office, I guess we'll see what happens.
Yeah.
So
I think the main point here being, and Nick, I'm going to ask you because you've been in the industry on the title side during a lot of elections, right? So, but I think the main point being the historical perspective in regards to commercial real estate prices, there's no direct correlation if a Republican or a Democrat wins the election. I think that's the main thing to keep in mind. The other factors that we've talked about, the waterfall effect, the business and consumer sentiment, where the interest rates may or may not be going, probably has a whole lot more impact in regards to the commercial real estate. But Nick, I mean, tell me about what your experience has been during election cycles on the title side and just seeing increased or decreased activity on that end.
It's from an overall perspective, there was a little bit of a decrease, but all in all, I would say that during the election year, it really didn't impact too much, from a transaction side or a volume amount. This year is obviously a little different with some different market effects, but I'd say historically, there wasn't a ton of shift either way as far as the election year versus non-election year. So, yeah.
Great. All right. Moving on to some questions. Hey guys, we got a question in. What if you had to invest in one or two areas in Kansas City? What are your favorite areas to invest in? Micah, why don't you take that away for the multifamily side?
what are my favorite areas to invest in Kansas City?
Yeah, submarket wise.
Yeah. Well, I mean, there's a few. Obviously, I think Overland Park is a fantastic location. There's a lot of great things happening there. We're seeing a lot of growth and development take place there. That one can be a little bit challenging to get into because it's well sought after. But that's a solid sub-market for sure. Another one is on the Missouri side, Lee Summit. That's a great location. A lot of people really like Lee Summit. There's a lot of growth happening there. And we're about to see a big amount of growth with the thousands of acres that are currently coming on the market. And it'll be interesting to see the plans that come forth from that and the developer that decides to come in and take that on. So there's a lot of undeveloped land across Lee Summit because it's been held by a group out in Utah for decades. And so that's why we haven't seen a lot of Lee Summit truly built out, and why you still see large sections of open land, and that's about to change in a big way. So Lee Summit for sure. And then I would say in the Northland, kind of the Riverside area and Liberty, those are some other submarkets, so kind of hitting the triangle around Kansas City. Those are markets that I think are really, really great growth markets.
Absolutely. Nick, do you have anything to add to that?
You get into the what if scenarios of potential, but I'd echo Mike on the Lee Summit and definitely Overland Park. But once again, it's tough to get into. But I'd keep an eye on KCK with some of their development stuff that they've got going and the access to state funds and the tax abatements out there. So I'd keep an eye on that as well, with a lot of acreage being out there. But other than that, I'd echo Micah's sentiments exactly. So
absolutely. How can somebody get in touch with us? Well, I mean, you can reach out to us on our website, XChangeCRE.com. That's XChangeCRE.com. We'd be happy to connect with you and talk about Kansas City Investments. All right. So now let's move into a few of the exciting activities and events that we have going on. In September, on Monday, September 23rd, we have our third annual Together We Win golf tournament benefiting Operation Breakthrough. We have a few sponsorships and very few teams, 3 to 4 teams still available. A couple sponsorships just got taken up yesterday, and I foresee that happening here over the next couple weeks. But it's going to be a great day. Hopefully the weather's going to be great. The course is in great shape. It's all a lot of fun. The team does a great job putting that event on. So we'd love to see you there. If you're interested in learning more, please reach out to myself or to Katie on our team, and we'll get you all of the information. We've also got some great meetup groups coming up here. In August, in 15 days, we've got our meetup group right after the Interface Kansas City conference at the Intercontinental Hotel. We'll be at the bar there on Ward Parkway on the plaza from 4:15 to 6:15. So hope to see you there. And then we're back to our regular programming at Strang Hall for September, October. We're going to skip November and December just because a lot of holidays happening in those months, and we'll be back at it in January. So please do come meet with us. Come see what we're doing here in Kansas City. If you're in town, make sure to come see us in person. We'd love to hang out. So if you want to get more information about our company and what we're doing in the Kansas City market, here's how to get in touch. Go to our website, reach out, make sure to follow us on LinkedIn. We're going to be bringing these market pulses to you every 2 weeks. So we'll be here again in 2 weeks and describing likely the 18.6-year real estate cycle, where we think we are, and how to bring out the crystal ball, because that is a hot topic with property owners, with investors, and with everybody there. Okay, guys, do you have any closing thoughts for everybody here that's listening today?
Go ahead, Micah.
Yeah, if you're thinking about doing something with your property and you need to get moving, I would say pull the trigger and give us a shout, and we can definitely help advise in that regard.
Yeah, I was going to kind of mirror that with timing is everything, and having the right people on your side to help you navigate that is really what it's about more than anything. But being able to have a candid and honest conversation with someone about, where conditions of the market and where we think everything is going to fall is the biggest task in anything. So reach out if you have any questions.
Well, gentlemen, thank you guys for joining today, and for all of our listeners. I got a report back that we had the most live listeners and viewers today, probably because Nick and Micah were here, not because of me.
Sure.
But we're going to be here every 2 weeks. If you do want to get in touch, here's how to do that again. We're just really excited about Kansas City. We're excited about conversations that we're having. We take a really advisory approach to helping you understand hold, sale, refinance. We're in it for the long haul. We're going to be here for a long time, and we're going to be here every 2 weeks. So thank you guys for joining. We appreciate it, and we'll see you in 2 weeks. Micah, Nick, thanks for being here.
Take care, guys.
See ya.